concept of NPV. NPV obviously stands for net present value. Now friends, at earlier classes you have learnt what is NPV. We will be going into depth of NPV and making sure that not just the calculation but the whole concept is clarified. So what happens when you have future cash inflows? You discount all those future cash inflows to their present values, and that will be the total present value of inflows. From that you subtract the initial amount of investment, or if your cost of the project is also scattered over the period, you bring all the outflows to their present values. So the present value of all the inflows minus the present value of all the outflows would give you the amount of net present value. So gradually what I will do is, with certain calculative examples, I will be bringing forward the complete discussion on net present value. But before we get started with any calculation, you should understand one thing very well, that we are applying the concept of time value of money, where there will be a rate of return that is expected by the company. That rate of return that is expected by the company will become the discounting rate, or simply the expected rate of return. You can mention it that way also. Why we call it discounting rate is, the present value of any cash inflow is always going to be lesser than the amount of cash inflow itself. So the amount of cash inflow, when it is converted to its present value, that present value of cash flow is also known as discounted cash flow. So if the expected rate of return is 10% per annum, what you will do is you will consider 10% per annum as discounting rate. Let me give you this by a simple example. Suppose you have 1 lakh at present and you invest that 1 lakh at 10% per annum, which is now your expected rate of return. So 1 lakh rupees of now will become 1,10,000 after 1 year. So the present value is 1 lakh and the future value is 1,10,000. Now if I ask you to convert that future value of 1,10,000 back to its present value, you know the present value calculations very well, but terminologies should be clarified. So the present value of that 1,10,000 would basically be 1 lakh. How we got that? By dividing 1,10,000 by 1 plus your expected rate of return, that is 1.1. So 1,10,000 divided by 1.1, and what you get is the present value of rupees 1 lakh. Now this present value 1 lakh can be considered as a discounted cash flow, and the rate of return that you are applying for computing this present value is therefore also known as discounting rate. So discounting rate basically indicates the rate at which the company is expecting the returns from any investment. It is basically a rate at which the company can reinvest its money. All the cash flows which the company is receiving can be reinvested at this rate. That is what we call as discounting rate. In simplest words, that rate is considered as expected rate of return. I will be talking about this discounting rate concept in little more details at a little later stage, but right now let us do one thing. Let us understand what will be this net present value. So what we are going to do, we will be having series of cash inflows and cash outflows at different points of time, which cannot be comparable. As a result, we will convert all the future cash flows to their present values. All future cash inflows will be converted to their present values. All future cash outflows will also be converted to their present values. And what we will finally do is total present value of inflow minus total present value of outflow is what we are going to get as net present value. That net present value, if it is a positive amount, it will indicate a benefit involved in that investment. If it is a negative amount, it would indicate a loss. So let us do one thing. Let us write some notes. Let us take some calculative examples to develop the understanding, and gradually we will have complete clarity on this whole concept with calculations. So based on what we have just discussed, please write the meaning of NPV. NPV is the present value of that surplus which the investor can earn over and above the expected rate of return. NPV is determined in the following manner. NPV equals to total PV of cash inflow minus total PV of cash outflow. With respect to NPV, the following important points must be considered. Let me take you ahead and give you those important points that you need to consider. First point, the present value of any cash flow will be obviously less than the cash flow itself. Such present value is therefore also known as discounted cash flow. The rate of interest which is used for determining the present value of cash flow is also known as discounting rate. The discounting rate indicates the expected rate of return for the investor. It is also known as cutoff rate, which indicates the minimum rate of return that is expected. If the investment project is capable of generating a rate of return higher than cutoff rate, then investing in such project is definitely beneficial. It indicates positive NPV. When NPV is positive, it indicates that project is capable of generating rate of return which is higher than cutoff rate. Let us move ahead and write further. Implications of NPV. Number 1. If NPV is positive, it indicates that investor is earning more than expected. If NPV is negative, it indicates that the investor is earning less than expected. If NPV is 0, it indicates that investor is earning exactly what is expected. If NPV is negative, the investment proposal should not be accepted because rate of return of the project is less than the expected rate of return. If NPV is 0, the investor should accept the investment proposal because the investor still earns that rate of return which is expected by such investor. Let us move ahead and take up the next very important question, that is question number 4. Let us read this question carefully. Initial outlay in a project is rupees 14 lakhs. Life of the project is 6 years. Scrap value of the project at end of the life is rupees 2 lakhs. Depreciation is to be provided on straight line method basis. Tax rate is 45%. The profit before depreciation and tax during the life of the project are as under. So they have given 6 years of life and each year's profit before depreciation and tax has been informed to you. Now as far as depreciation is concerned, your initial cost of the project is 14 lakhs. Scrap value at end of the life is 2 lakhs. So the depreciable amount will be 14 lakhs minus 2 lakhs. That will be 12 lakhs, which will be charged over 6 years period on a straight line basis. So that will be 12 lakhs divided by 6 years. So annual depreciation would be simply rupees 2 lakhs. Let us read further what is given in the question. Calculate the net present value of the project using the following discounting rates, that is 12%, 15% and 18%. So this time you have to simply compute the net present value, but you have to apply 3 different discounting rates. So let us see how to write up the solution in this case. So here what you will do is, you first show the calculation of annual depreciation as I have explained to you, and then show the calculation of annual cash flows. So for calculating annual cash flows, the way we have seen the tabular presentation in the previous question, exactly same way. So first year your profit before depreciation is 5 lakhs, second year it is 5 lakh 20,000, third year it is 5 lakh 40,000, fourth year it is 5 lakh 25,000, fifth year 5 lakhs and sixth year it comes to 4 lakh 80,000. These profit before depreciation and tax figures are informed to you in the question. Now annual depreciation, what we have just worked out, is rupees 2 lakhs each year. from the amount of profit before depreciation and tax. When you subtract the amount of depreciation, what you will get is profit before tax. Tax rate given in the question is 45%. So profit after tax will be 55% of profit before tax. So you can easily compute the amount of profit after tax, and then to the amounts of profit after tax, when you add back the depreciation amounts, what you will get is the annual cash flows, and annual cash flows are obtained for each of the 6 years of the project life. Now once we have obtained the annual cash flows, we are simply going to compute the net present value, but this time we have to apply 3 different discounting rates. So let me show the summarized calculation through one singular table which is presented in this style. So I will be showing you first the calculation of NPV at discounting rate of 12% per annum. So what I will do is, the annual cash flows and terminal cash flows for the project life what we have obtained will be just plotted in this table as initial information. So 6 years of project life and 6 years of annual cash flows have been plotted over here. Not to forget that by end of 6th year you will again get some terminal cash flow. So once again I would write 6 and the terminal cash flow is 2 lakhs. So don't ever get confused over here. This 6 and 6 have been written twice. This is the usual annual cash flow of 6th year which we have obtained in the previous table, and this is the cash flow that will arise on termination of the project, which is called as terminal cash flow, which is going to be rupees 2 lakhs. Now what I am simply going to do is, I will be applying the present value calculations using 12% discounting rates, and accordingly these are the factors that you would obtain. When you are plotting the 6th year's calculation, make sure of one thing, that 6 over here you have written twice, that is first 6th year is representing the annual cash flow, then again you have written 6 years for terminal cash flow. Make sure that the present value factor that you write in 6th year should be the same factor that you write in the last line over here. These two factors must necessarily be same. So when you multiply the amounts of cash flows to their respective present value factors, you will get the amount of present value of inflows, and when you sum it up, you will be getting the total present value of cash inflows, which comes to 16,29,583, and from this when you subtract the amount of total present value of outflows, what you will get is 14 lakhs subtracted from 16,29,583. The result will be net present value of rupees 2,29,583. Now what we are going to do is, we are going to apply discounting rates of 15% and 18% also. So same style the calculation will be done. So I don't have to explain you, I am just showing the calculations. You may take note of the same. It is only after your calculations are completed, I will have a conceptual discussion over here, that what happens to NPV when the discounting rates are changing. This is something very, very important. So just take note of all these calculations carefully, and once you are done with this, we will definitely have the conceptual discussion on this whole matter. Now I don't want you people to restrict your knowledge just relating to calculations. You need to have clarity on the concepts. So please try to understand one simple thing. If I give you a simplest example, just try to observe what I am trying to convey. If you have rupees 1 lakh in hand and you are expecting a return of 10%, so what will happen? If you invest 1 lakh today, you would expect to get back 1,10,000 after 1 year. Correct? 1 lakh if you invest now, you should get 1 lakh 10,000 after 1 year. What if I give you 1 lakh 12,000? Then you are getting surplus of rupees 2,000. That surplus will be computed by end of the year. NPV is the present value of that surplus. So just imagine, if I give you cash flow of 1 lakh 12,000, where your expectation was only 1 lakh 10,000, then you are getting a surplus, and that is where you get benefit by investing in any project. You are basically targeting a rate of return of 10%. If you get something more than that, you are more happy. My point is, NPV is the present value of that surplus. So just imagine, try computing the present value of 1 lakh 12,000 for 1 year. So pick your calculator. 1 lakh 12,000 divided by 1.1 will give you the present value of 1 lakh 12,000. From that, when you subtract 1 lakh, what you will get is 1818. That is going to be your NPV. That is one thing. On the other side, if you evaluate it this way, that your 1 lakh as per your expectation should have become 1 lakh 10,000, but what you are getting is 1 lakh 12,000, means you are getting a surplus amount of 2,000. If you simply find the present value of that surplus, it will be nothing but the NPV. So what is the real meaning of NPV? It is the present value of some surplus. Which surplus? A surplus that you would earn over and above your expected rate of return. So in this project, we initially had expectation of 12%. We got a positive NPV at 12% discounting rate. That is a clear indication that this project is capable of providing you returns more than 12%. So we had increased expectation, and now we are analyzing the same investment with 15% expected rate of return. That means if I am being told that, sir, your investment in this project is going to provide you rate of return of more than 12%. I would ask you, why more than 12%? Because at 12% discounting rate, you are getting a positive NPV. If you are getting a positive NPV, means you are going to earn some surplus over and above your expected rate of return. Now, if your expected rate of return is 12% and you are getting a positive NPV, you have now understood that the project is capable of giving you a rate of return higher than 12%. Now what will happen? You have now attempted the NPV calculation with 15% discounting rate to check whether this project is giving you more than 12%, means how much? Is it giving you 15% return? When you attempted the calculation of NPV using 15% discounting rate, the project still gives you a positive NPV. What does that indicate? That project is capable of giving you a rate of return even higher than 15%. So the third calculation what we attempted was by 18%, and at 18% you got a negative NPV. Now negative NPV doesn't indicate a loss actually. It indicates that the rate of return that you are actually earning in this project is lower than your expectation of 18%. So one thing is for sure, in this case, the expected rate of return when it was 12%, you get a positive NPV of 2,29,583. When you have increased it to 15%, you get NPV of 93,000. How much it is? 691, 93,691. And by the time you take the discounting rate as 18%, you get a negative NPV. What is the indication? The return generating capacity of this project is higher than 12%. It is even higher than 15%, but not as high as 18%. That means the return generating capacity of this project is greater than 15%, but less than 18%. that return generating capacity of the project would be lying between 15 and 18%. We call that rate of return generating capacity as internal rate of return. In questions ahead, we will learn how to compute internal rate of return definitely. But as of now, these implications what we have drawn from this question number 4, let us point it out very well. One more thing that I want you to understand is, as and when you are increasing the discounting rate, the NPV is getting reduced, correct? It is clearly observable over here in this table. So we conclude one more point, a very rational point, that is when the discounting rate rises, NPV declines and vice versa. That means the NPV is inversely related to the discounting rate. Higher the discounting rate, lower will be the NPV and vice versa. Now friends, just imagine that if your rate of return that you are expecting is 10% and today you are investing 1 lakh, your expected value after 1 year will be 1,10,000. What if I give you 1,08,000? This time there will be no surplus, but there will be a shortfall in your expectation, means your expectation is not getting fulfilled. That is the time when you get negative NPV. A negative NPV indicates that you are not earning your expected rate of return. So here from the calculations it is clear that your expected rate of return when it is 18%, you are not earning 18%, you are earning less than that. Now suppose if your expected rate of return is 10% and today you have invested 1 lakh, after 1 year you would want 1,10,000. What if I give you exact 1,10,000? There will be exact returns that you earn what you expected, but there will be no surplus, means the NPV would be 0. When the NPV is 0, your project is giving you the rate of return that you have exactly expected, no surplus, no deficit. However, when it comes to NPV based decision making criteria, what you would do? For positive NPV, definitely you accept the project because it is giving you rate of return more than what you require. If it is 0 NPV scenario, still you accept the project because it is giving you the rate of return that you expect. Only when the NPV is negative, where the indication is clear that you are not earning what you are expecting, you should not invest into such projects. So let us note down these important points of implications from what we have seen in question number 4. So based on what we have just discussed, please write under the heading implications of NPV in reference to question number 4. When the expected rate of return is 12% per annum, the resulting NPV is positive, which indicates that the project is capable of generating a rate of return higher than 12%. When the expected rate of return is 15% per annum, the resulting NPV is positive, which indicates that the project is capable of generating a rate of return higher than even 15%. When the expected rate of return is 18% per annum, the resulting NPV is negative, which indicates that the project is capable of generating a rate of return that is lower than 18% per annum. And we have concluded one more point. It can be concluded that IRR, that is internal rate of return of this project, is between 15% per annum and 18% per annum. Let us move ahead and discuss the next concept ahead, that is concept of IRR, what we call as internal rate of return. So please carefully try to understand the concept first. What we have observed from the previous question, you have analyzed a project using NPV approach or using NPV method. What did you notice? You have tried computing NPV of that project using different discounting rates. So we have already discussed what exactly is the proper meaning of NPV. When you get a rate of return more than what you expect, the resulting NPV of that project will be positive. I have given you examples already to clarify the same. In other words, a positive NPV indicates that the project is providing you return more than what you expected. I would rather say a rate of return more than what you expect. A negative NPV on the other side indicates a rate of return that is generated by the project is less than what you expect. In other words, project is not capable of providing you a rate of return that you expect. So what would happen when the NPV is 0? When NPV is 0, we will say that the project is capable of generating exactly that rate of return which is expected by the company. So, point is very clear. If rate of return generating capacity of the project is greater than the expected rate of return, it will result into a positive NPV. If the return generating capacity of the project is lower than the expected rate of return, the project will provide you a negative NPV. If the return generating capacity of the project is exactly matching with the rate of return that you expect, it will give you 0 NPV. And NPV is the surplus over and above your expected rate of return. Now, if you want to find out what is the rate of return that the project can generate, in other words, you want to find the return generating capacity of the project, that means you are targeting the computation of this internal rate of return, because internal rate of return indeed means the same, that is the rate of return generating capacity of any project. Now, point is very clear. If you are trying to determine that internal rate of return, you should select a discounting rate through which the NPV gets exactly 0. Now, there is no device available where we can compute that IRR directly. Therefore, the only method available in this planet is trial and error method. That means you try computing NPV at any random discounting rate, or it may be a thoughtful rate, and if you have arrived at NPV, look into one thing. Your objective is to get NPV which is 0. So if you get a positive NPV, what you should do is use a higher rate in the next trial so that the NPV gets reduced. Finally, what you do is you land up at a range of lower and higher discounting rates. The lower discounting rate should be the one at which the resulting NPV is positive. The higher discounting rate should be the one at which the resulting NPV is negative. Then there is a mathematical technique called interpolation, where you average out and find an approximate rate between the two, that is between the lower discounting rate and higher discounting rate, where the resulting NPV could be 0. That is basically an approximation technique, but that is the only technique available. To have maximum accuracy, the gap between the lower and higher discounting rate should not be more than 1%. The lower the gap between the lower and higher discounting rates, the better will be your result. So, what two things you need to do for computation of IRR? Try to understand this very well. You attempt computing NPV closest to 0. You may not get exact 0, so let it be a small positive amount, and try using another such rate at which you are getting a negative amount. So with a higher rate of discounting, you will get a negative NPV. With a lower rate of discounting, you will get a positive NPV. That range will be the range within which the IRR will lie. If you get that range as close as possible, and I told you preferably not having a gap more than 1%, then your chances of getting closest to accurate IRR will be higher. Then use interpolation technique to arrive at that, and how to use that interpolation I will explain in the upcoming example. So let us do one thing. Through what we have extracted as conclusion from question number 4, we will take up another question, that is question number 5, and just deal with the same data of question number 4 and determine the internal rate of return. So let us take up question number 5 and let us read this question. Calculate IRR by using the data given in question 4. So what we can simply write up is NPV at expected rate of return of 15% per annum is rupees 93,691. NPV at expected rate of return of 18% per annum is negative 24,982. So IRR of the project must be between 15% and 18%. Let us move ahead and now apply interpolation formula for determining IRR. So here goes the formula. IRR equals to LDR plus NPV at LDR divided by NPV at LDR minus NPV at HDR multiplied by HDR minus LDR. So if this kind of formula gives you discomfort, do not worry at all. How to logically arrive at this formula, I'll explain you in a short while, and there is no need to as such even apply this formula. This is for those who do not understand the logic of interpolation. For those who understand the logic of interpolation, there is no need of any formula application. However, if you are anyway applying this, LDR stands for lower discounting rate, which in our example is 15%. HDR stands for higher discounting rate, which in our example is 18%. And NPV stands for net present value. IRR stands for internal rate of return. So let us substitute the values over here. LDR will be 15. NPV at LDR is 93,691 divided by NPV at LDR again, that is 93,691 minus NPV at HDR, which itself is a negative value, and multiplied by difference between HDR minus LDR, that will be 18 minus 15. Now if you carefully look at the denominator over here, that is 93,691 minus negative 24,982. When you open the brackets, minus into minus will actually get added, and finally what will happen, 93,691 divided by the denominator comes to 1,18,673, which is basically 93,691 plus 24,982 multiplied by 3. 3 is the difference between HDR and LDR, and when you apply this calculation, what you get is 17.368%, and because we have applied interpolation, the result is not known to be accurate. Result will be an approximate result. That is what we have mentioned over here within brackets. So LDR over here stands for lower discounting rate, which was 15%. HDR stands for higher discounting rate, that was 18%, and IRR, what we have just computed, is basically internal rate of return. Now let us move ahead and try to understand the interpolation logic, and this is something very, very important. Can you notice I have drawn a straight line and I have marked 15% at the extreme left and 18% at the extreme right. These 15 and 18% are basically the lower and higher discounting rates, and at 15% the NPV what we get is a positive 93,691. At 18% what we get is negative 24,982. So now let us find the gap between the lower and higher discounting rates. The gap between 15 and 18% is basically 3%. Now let us also find the gap between positive 93,691 and negative 24,982. If I ask you to find that gap, do you know what you will do? You will simply take 93,691. From here you will travel to 0. So from 93,691 to 0, the gap itself is 93,691, and from 0 point you will further go to negative 24,982, which increases the gap. So gap between these two numbers will be actually aggregate of 93,691 and 24,982. The gap comes to 1,18,673. Now What we interpret from a positive NPV, we have already discussed earlier. When you have expected rate of return of 15%, the NPV is positive, means the project is capable of generating a rate of return higher than 15%. How much is that rate of return, we don't know, but one thing is for sure, it is higher than 15%. So look at what I am doing now. I will now write a line as IRR equals to 15% plus a question mark, means some unknown value, something added to 15%. Now we need to find this question mark value. If we are able to find this value, we will get IRR easily. So now let us find logically this question mark value. So what we have to do is, we have to arrive at such a rate of discounting where NPV comes to 0. So we wanted to reduce the NPV. To make it 0, we should reduce the NPV by 93,691. When we increase the discounting rate from 15% to 18%, the discounting rate was increased by 3% and the decline in NPV was by 1,18,673. So we wanted to reduce the NPV by 93,691, but NPV got reduced by 1,18,673. That is why NPV resulted from this positive value to this negative value. So what we are trying to conclude is, when we increase the discounting rate by 3%, the reduction in NPV is by 1,18,673. So what should be the increase in discounting rate? So that reduction in NPV is by only 93,691. Why 93,691? Because at 15% you are getting a positive NPV of 93,691. You want to make your NPV 0. So NPV should be reduced by 93,691. So when we increase the discounting rate by 3%, the NPV dropped by 1,18,673. So what should be the increase in discounting rate so that NPV drops by 93,691? That logic you simply apply. For 3%, 1,18,673. So for what increase you would get 93,691 of difference. So simply cross multiply to get the value of question mark. So question mark value will be 3% cross multiplied to 93,691 divided by 1,18,673. That's all. That's the logic that you have to apply. The question mark value will be 93,691 divided by 1,18,673, and that will be multiplied to 3. And what you get is 2.368 as the value of this question mark. So question mark value when added to 15%, you are getting IRR. So 2.368% when added to 15%, you will be getting IRR as 15% plus 2.368%, and that comes to 17.36% approximately. Now please carefully pay attention to one thing. When you have written the IRR formula, what did you write in the formula? You started with LDR, which is 15%. Then in this ratio, in the numerator you took NPV at LDR, that is 93,691. In the denominator you have taken difference between NPV at LDR and NPV at HDR, that was 1,18,673, and that whole thing you have multiplied by 18 minus 15%, which was 3. So indeed, from this logic itself, the interpolation formula has been derived, which you have already written and applied for calculation. Now let us move ahead and write some important notes, getting started with the meaning of IRR, that is internal rate of return. This is the rate of return which indicates capacity of a project to generate cash flows. If internal rate of return, that is IRR, is considered as discounting rate, in other words, the internal rate of return itself is made as discounting rate or the expected rate of return, the resulting NPV will be 0. Let us move ahead and write those important notes. So point number 1 over here, IRR indicates the return generating capacity of the project. Cutoff rate or discounting rate indicates the expected rate of return of the investor. You should never forget that the cutoff rate or discounting rate is what investor is expecting, and IRR is what the project is capable of providing as rate of return. So third point, when we write if discounting rate is greater than IRR, means the investor is expecting more and IRR is less, the resulting NPV will be obviously negative. This is because investor expects a rate of return higher than the rate that can be generated by the project. Let us move ahead and write further. Fourth point, when discounting rate is greater than IRR, the project is rejected, and it is obvious because we have seen earlier that in such a scenario the resulting NPV will be negative. Now fifth point, if the discounting rate is lower than IRR, it will obviously result into a positive NPV. This is because the investor expects a rate of return which is lower than the rate of return that can be generated by the project. So when discounting rate is lower than IRR, the project is accepted. Let us move ahead and write up couple of more points. When discounting rate is equal to IRR, that means the expected rate of return is exactly matching with the rate of return that can be generated by the project, the resulting NPV will be 0. This is because the investor expects exactly the same rate of return, that is the capacity of the project to generate. Even in this scenario, the project is accepted because the investor still earns the expected rate of return. Now one last point which I am making you write, the eighth point. You may not understand the complete meaning of that point, so I am not going to explain anything relating to this eighth point. Just note it down. It is at later stage when you will understand the meaning of this eighth point, because it is a connecting matter. In terms of notes, I have given this eighth point over here, but surely we will be discussing this point in the coming classes.